The chat box and the Q&A box will be open for questions. I'm going to be monitoring that throughout the webinar. So again, thank you, Jonathan, for joining us. I'm going to turn it over to you.
You bet. Thank you so much, Sarah, and thank you everyone for joining us. I really do appreciate you investing your time in this. I hope that you will find it worthwhile. The Corporate Transparency Act is a new law. It took effect at the beginning of this year, January 1, and it is going to affect more than 32 million small businesses in the United States. In all likelihood, it will affect yours one way or the other. And so what I'd like to do now is give you an overview as to how this new law works, some things that you should be doing right now to get ready, and then some thoughts about how you can take it from there. As Sarah mentioned, I'm both an attorney with the Taylor English Law Firm. If you need legal advice as to the Corporate Transparency Act, we can certainly help you there. If you know what you need to know to file, you can use my software at fincenreport.com, and I'll talk a little bit about that later on to show you how it all fits together. So the Corporate Transparency Act is a new law. It was passed by Congress at the end of 2020, and it was implemented at the beginning of this year by the U.S. Treasury Department, in particular through its division called FinCEN, which stands for the Financial Crimes Enforcement Network. To be clear, my company is fincenreport.com. FinCEN is a division of the U.S. Treasury, part of the U.S. government. And to understand how this law works, there are some key vocabulary terms that you need to understand. Those are words like reporting company, which reporting companies are exempt, and then what it means to be a beneficial owner or a company applicant. So I want to go over those key vocabulary terms. I'm going to stop after each major idea, take a breath, and give you an opportunity to ask questions. Once we've resolved each question for each segment, I'll then move on to the next one. Then at the end, I'm probably going to zip through it kind of quick. I often give this presentation to lawyers and they want to get into examples and hypotheticals. So I have a lot of those at the end of the slides. That's probably a little farther down in the weeds than we want to do today. But towards the end, I will walk through what will be the logical process that you would want to go through with your company to figure out if you have to file, and if so, what you need to include. So to jump into the details, as I mentioned, Corporate Transparency Act is a law that was passed by Congress. It was initially vetoed by President Trump. It was then overridden by a 2/3 vote of both the House of Representatives and the Senate at the end of 2020. The law actually amends another law called the Bank Secrecy Act. If you've ever opened a bank account for one of your companies and you have to fill out a KYC form or know your customer form, that is also under the Bank Secrecy Act. This is a new concept that is also going to apply under that law. What's going to happen under this law is that every company that is not exempt is going to have to file a report. FinCEN, a division of the U.S. Treasury, is going to compile them all into this big database. And then that database is going to be made available to law enforcement so that they can fight money laundering. Money laundering is a way that criminals take illicit cash and disguise it so that it looks like it was earned honestly and then pay tax on it, then using that post-tax cash in the financial system. By fighting money laundering, we make all kinds of other crimes go away. And one of the chief tools that the government needs to fight money laundering is the elimination of corporate anonymity. As you know, today you can form a corporation or an LLC with very little information being included in the public record. In fact, it might only have your lawyer's name when he signs the articles, and then an address for the lawyer. They might not know that you're involved at all. They won't know any investors that you have in the company. They won't know who the officers are of the company. Well, the Corporate Transparency Act is going to end that anonymity by building this big database up at FinCEN where all these companies' beneficial ownership will be recorded. Now, that database will be confidential. We won't be able to look it up ourselves. The public will not be able to see it, but law enforcement and some financial institutions will be able to access it, subject to some controls that are going to be administered by FinCEN. So that is the Corporate Transparency Act. How the Corporate Transparency Act works is this. And if you don't remember anything else, remember the first sentence on this slide. Every reporting company that is not exempt must file a BOI report that discloses five pieces of personally identifiable information for each of its beneficial owners. Now, each of those words is a special defined term that I wrote a book actually last year, the Corporate Transparency Act Compliance Guide. Each one of those words is basically a chapter of the book because the definitions are so detailed. But we're going to give you a sense of what that is today. So a word about timing. Most of us, here we are at early February, if you have a company today, it was probably formed before January 1, 2024. If you have a company that was formed before that date, you have until the end of 2024 to file your first report. So good news, you have 10 and a half months. When you file that report, you're going to have to include the names of your beneficial owners and then the 5 specific items of PII for each of those beneficial owners. If your company was formed, and by formed we mean the document was filed with the Secretary of State that caused it to begin its existence. If your entity was formed on or after January 1, you have to file much sooner. You're going to have to file within 90 days of the date of formation. In addition, when you file, you are also going to have to include the name of your company applicant and the 5 pieces of PII for the company applicant. We're going to explain later what that is. Now, there is no annual renewal concept. Once your company files its BOI report, it's good to go. However, you can't just set it and forget it. If the identifying information for any of your beneficial owners should change, you must amend your BOI report within 30 calendar days to reflect that change in data. In addition, if any of the beneficial owners of your company should change, a new beneficial owner should come into the company, or an existing beneficial owner should depart the company, either one of those events, a change in beneficial ownership, also triggers a need to file an amendment. That amendment, again, is due within 30 calendar days after the change. So, important to get this right, because remember, this is an anti-money laundering law. Congress assumed, and the regulators assumed, that there are bad actors that are going to try to circumvent these requirements. So there are all kinds of sanctions involved if we get this stuff wrong. First, if you miss any of the timing rules, you could theoretically be liable for a $500 per day fine. Don't stress out too much. FinCEN has said that they're not going to be assessing fines in the first year. They just want people to get the reports done. Nevertheless, we need to take this seriously because those assurances are not law. That's just statements that the regulators have made. In addition, a willful failure to file, or a willful filing of false information, or a willful refusal to file information that is required to make the report true, any one of those things is a felony, punishable by up to 2 years in prison. If that felony willful failure takes place in combination with another money laundering crime, such as tax evasion, then the sanction actually gets multiplied up to 10 years in jail. So I'm going to stop and take a breath and get a glass of water here. Are there any questions about the timing rules? Pre and post January 1, 2024, you're either filing by the end of this year or you're filing within 90 days from the date of formation. Any questions on that timing concept?
I am not seeing any questions come in the Q&A or the chat yet. So just a good reminder, though, for those of you who might have questions, feel free to pop them up anytime that you think of them.
All right. So we know our timing rules. We know what the Corporate Transparency Act requires. Remember our mantra at the beginning: reporting companies that are not exempt must file the BOI report identifying the 5 pieces of PII for each of the beneficial owners. So what is a reporting company? Well, reporting company comes in 2 flavors. It can either be a domestic reporting company or a foreign reporting company. A domestic reporting company is a corporation, an LLC, a limited partnership, or any other entity that is formed by the filing of a document with the Secretary of State. Now, corporations, LLCs, limited partnerships, that's 99% plus of all the small businesses. That probably covers everybody. There are some edge cases involving general partnerships, certain kinds of trusts. I don't need to go into that. I said that there's a reporting company there's a domestic reporting company. There's also a foreign reporting company. If you are a foreign reporting company, that means that you're an entity that was formed outside the United States. For example, you're up in Michigan, a Canadian corporation, for example, that does business in the US, perhaps a UK corporation that does business in the US. Those foreign entities may become foreign reporting companies if they do business in the US and they file a document with the Secretary of State for permission to do business in the US. If you happen to fall into one of those categories, you would be a foreign reporting company. So I'm going to stop right there as we go on to the next slide. Any questions about what a reporting company is? That's the easy part. Okay. I'll keep my eyes open to see for any questions in the chat. Okay, so if you're a reporting company, then you need to be thinking about this law because you're either going to file or you're going to be exempt. What kinds of companies are exempt? There are 23 different types. They're listed on your screen. I can't read them all to you. It would take a little too long. But in essence, they include a whole bunch of regulated entities like publicly traded companies, banks, insurance companies, entities that have a money service business license from FinCEN, bank holding companies, securities broker dealers, and things of that nature. The type of exemption that is most likely applied to small businesses is in the upper right-hand corner, and it's called the large operating company exemption. I won't have time to go all the way into the details in that one today, but you may be exempt under the large operating company exemption if you meet all three prongs of the test. First, you have a place of business in the United States. If everybody works from their house, then you don't have a place of business, and this prong will not apply to you. But if you have a place of business, that's number one. Number two, 20 or more full-time employees using the definition of full-time employees from the Affordable Care Act. So 20 or more under that method of counting, and you have satisfied the second prong. The third prong, which is the hardest one to satisfy, is that you have $5 million in U.S. source gross receipts for your previous year's tax return. So here we are in February of 24. Probably no one has filed their taxes yet. April 15, if you filed your tax return and it's got more than $15 million from U.S. sources in it as gross income, and you meet the 20 employee test and you have a place of business, you will be exempt as a large operating company. If you are exempt, you do not need to file a report. Hooray for you, you're free. But be careful, if you are exempt and you do not file a report, and later on the facts change so that you lose one of the three prongs of the exemption, for example, you have a layoff and you now have fewer than the 20 employees, bam, you lose your exemption on the date that 20th employee leaves the company. That starts a 30-day clock ticking. Within 30 days after that event occurs, you're going to have to file your first BOI report because you're no longer exempt. So just be aware that there are exemptions. If you think that one of the exemptions may apply to you, you should consult your attorney to make sure, because if you guess and you get it wrong and you don't file, remember, all the criminal sanctions could apply to you. So those are the exemptions. I see that there's a question here about what do we disclose on the day that we file. I'm going to get to that a little bit later on in the presentation, so hang on to that question. Okay, now remember, we have two sets of timing rules. One set of rules for pre-2024 companies, another set of rules for companies formed on or after January 1. Companies formed prior to 2024, you do not need to know who your company applicant is. Not now, not ever. So just forget about that if you are a pre-2024 company. If you are a company that was formed on or after January 1, 2024, you will need to know who your company applicant was. The definition is a little bit complicated. You will need to consult an attorney for help with this. In essence, though, the company applicant is the individual who directly files your document with the Secretary of State that causes your corporate existence. This might be a paralegal at a law firm. This might be an employee of a corporate service provider who is the person who directly files the document. In addition, if more than that one person was involved in preparing the filing, the company applicant also includes a second individual who was the one primarily responsible for directing or controlling the filing. Now, I'm going to leave it at that. I'm not going to go into the details. In short, if you are a company formed on or after January 1, 2024, you should consult with an attorney to make sure that you get your company applicant identified correctly. All right, so if you're a reporting company and you're not exempt, you are going to have to file a report. The timing rules we talked about earlier. In your report, you have to identify by name every beneficial owner of your company. But what is a beneficial owner? The definition of beneficial owner is spelled out in FinCEN's regulations, and you are a beneficial owner if you meet either of these two tests. You are one if you own or control 25% or more of the ownership interests in the company. You are also a beneficial owner if you exercise substantial control over the reporting company, even if you don't own anything at all. Now, that sounds kind of simple, but there are lots of details. Here is the place where you might need some legal help. Now, if it's just you and you're the sole owner of your company, that's easy. You own more than 25%, you're going to be one of the beneficial owners of your company. But if you have 4 individuals and you divide it up one way or the other, that's where the legal help may come in. So let's talk about both the ownership test and then the substantial control test. I'm not going to try to read through all of this. Just be aware that when we measure the ownership percentages of individuals in a company, it's not simply a question of who has 25% or more of the vote, or who would get 25% of the value if we liquidated the company. There are several different rules you need to apply. The first is the present time rule. That says that when we're calculating percentages, we are going to treat all convertible securities and instruments as if they were converted. This means stock options, convertible notes, warrants, all kinds of stuff like that. We're going to treat those instruments as if they had been converted and then calculate our percentages based on that number. There's then what's called the partnership capital rule and the corporate capital rule. Again, I'm going to skip over the details. If your entity is taxed as a partnership, there's one way of calculating percentages for you. If your entity is a corporation, an entity that issues stock, then there is a different method of calculating percentages for you. If either one of those situations apply and you have enough investors in your company that it's not obvious right on the face of it who it is that has more than 25%, I would strongly encourage you to get legal help to apply the partnership capital rule, the corporate capital rule to you. In certain situations, we also then don't apply either one of those 2 rules, and we apply what's called the fail-safe rule, where we treat everyone as a beneficial owner if they own 25% or more of any class or type of security in the company. Again, we're going to flip right through that. It actually creates an interesting logical tree that I teach to the lawyers when we do seminars like this for lawyers. You first figure out whether you're a partnership or a corporation. You apply either the partnership capital rule or the corporate capital rule. You then ask yourself, does that rule produce an outcome with reasonable certainty? This has to do with how the percentages are measured if we would liquidate the value of the company and distribute it. That produces a yes/no answer. If the answer is yes, then you're done. If the answer is no, then we apply that fail-safe rule. That's the 25% of any class or type of security. But like I said, we're going to zip right through that. The second prong of the beneficial ownership definition is that an individual is a beneficial owner if they exercise substantial control over the reporting company. This is the complicated part. An individual exercises substantial control if they meet any one of the 4 tests. That's my dog barking in the background. Any of the 4 tests in this definition. It doesn't mean that you have power to do whatever you want. It doesn't mean that you have a veto. It doesn't mean that people respect your opinion and therefore you've got control. We have to very carefully walk through all 4 prongs of this test. If an individual trips any one of these 4 prongs, then they have substantial control. Then we must disclose them as a beneficial owner. Subsection A, if they are a senior officer of the reporting company. The title of the individual does not matter. The term senior officer is defined in the regulation. It means any person who is the CEO, chief operating officer, chief financial officer, general counsel, or any other person who serves a similar function regardless of their title. So the person who acts like the CEO, they are the CEO, they are a senior officer. We count them as a beneficial owner. The person who is the CFO probably has the checkbook, they control the bank account, they run payroll. That individual functions like a CFO. They are a CFO, even if you call them something else. That individual needs to be disclosed as a beneficial owner. Subsection B, a person who has the authority to appoint or remove any senior officer or a majority of the board of directors. We would include that person, even if they don't own any stock, even if they aren't employed by the company. If they have that power of appointment, they're a beneficial owner. Subsection C, this is the most complicated one. An individual who directs, determines, or has substantial influence over important decisions. That person is a beneficial owner. The 7 subparts are just non-exclusive examples of types of major decisions. FinCEN was very clear that these are not all the types of major decisions there are. In short, if you think it's an important thing, it probably is a major decision, so we would care about it. The intro to subsection C, directs, determines, or has substantial influence over. Again, it's not enough that the individual has a veto. It's not enough that their vote is enough to carry the vote one way or the other. If they have substantial influence on any of these important decisions, then they are a beneficial owner. Now, here's one place where you got to be careful. In my book, if a corporation is a reporting company and it has a board of directors, I think every member of the board of directors has substantial influence over important decisions and therefore ought to be disclosed as a beneficial owner. If you actually went to FinCEN's website, however, they have a whole bunch of FAQs. One of the FAQs says, does every member of the board of directors need to be included as a beneficial owner? And the answer they give is no. You only need to be disclosed as a beneficial owner if you have substantial control. Well, that's an answer that's true but misleading. It's true, substantial control is the test. It's not the test whether or not you're on the board. The point, though, is that every person on a corporation's board of directors does, in fact, have substantial influence. They're there with a vote on the matter at hand. They have access to all the same information. They have the ability to talk to the other members of the board about the decision. Those are all matters of influence. Those are all substantial matters of influence. And therefore, I think the prudent rule is to count every one of your board members as a board member having substantial control for purposes of the beneficial ownership test. And then finally, subsection D, as you can see, this is a catch-all. This is an anti-money laundering law. They know that there are sharp operators that are going to try to circumvent this. So they throw out this umbrella, and any other form of substantial control over the reporting company, that's something that we're going to count. I call this the Tony Soprano test. If you remember on the Soprano show, there was the Italian restaurant that Tony hung out at a lot. And Tony wasn't on the board. He didn't own it. He wasn't an officer of the corporation. His name didn't appear in any of the paperwork. But he had a key to the place. He would hold meetings in the back. He would come and go at all hours of the night. And if he wanted cash out of the till, he would take it out. If that particular company was in front of this rule, I think that company ought to be disclosing Tony Soprano as a person with substantial control because they did what he said. They did what he said, even though he wasn't on the board, he didn't own stock, and he was an officer. So that's the definition of substantial control. Again, to repeat, you are a beneficial owner and therefore need to be disclosed either if you have substantial control under the multi-part test, or if you have 25% or more, remembering that there are different rules for how you calculate 25%. So I see that we have a question here. I'm going to return to this question real quick. The individual needs all 4 or only one? Only one. So just to make sure, if you are a senior officer of a reporting company, you have substantial control, you are a beneficial owner. If you have authority over the appointment or removal of any senior officer, you have substantial control, you are a beneficial owner. If you have substantial influence over important decisions made by the reporting company, you have substantial control, you are a beneficial owner. So if you are Tony Soprano in subsection D, you are a beneficial owner as well. Any one of the 4 is sufficient. Okay, so this is your decision tree. And again, if you have a simple company where you are the only owner, you and your spouse are the only 2 owners, you are your spouse and your brother-in-law are the 3 owners, and you split everything in thirds, this becomes really easy. In the case of you, your spouse, and your brother-in-law, each of you own the business in thirds. All 3 of you are going to be beneficial owners because you own more than 25%. If you, your spouse, and your brother-in-law are the CEO, the CFO, and the general counsel, you're also beneficial owners by virtue of substantial control. You don't need to look at any of the other rules. For you, it's simple. For others, you may have to work your way through this decision tree. And that is it a reporting company? Is it exempt? If it's not exempt, who are the beneficial owners applying the 2 prongs of the test? And then who are beneficial owners by virtue of substantial control? Once you have that full list of beneficial owners, you're going to have to fill out the report and file it for your company, including all the information for those beneficial owners. If your company existed before 2024, you do not need to figure out who the company applicant was. You'd never need to know about that. If your company was formed on or after January 1, 2024, you will need to figure out who was the company applicant. You will probably need a lawyer's help to do that. Okay, don't worry about that. So what actually goes into the report? And this is going to respond to the question about who do you disclose as members. When you file, you're going to file information that's true and correct as of that day. When you need to file depends on when your entity was formed. That was the timing rule that we talked about at the very beginning. So for most of us that are going to be pre-24 companies, you need to file before the end of this year. On the day that you file, you will need to include for the name of the company, its legal name, any trade names or DBAs, its current street, principal place of business, the jurisdiction where it was formed, and its taxpayer identification number, or EIN. Then for each of those beneficial owners that you just identified, you're going to need their full legal name, date of birth, their residential address, can't be the business address, and then a unique identifying number. The unique identifying number could be a US driver's license or a US passport. If an individual does not have either of those two, they may also use a foreign passport. If they do not have any one of those three things, you have a problem, consult a lawyer, because those are the only three types of documents that are permitted. If you are a post-24 company and need to identify your company applicants, you provide the exact same 5 pieces of PII for the company applicants, except that a company applicant that is in the business of forming companies may use their business address in lieu of their residential address. So I see I have a couple more questions here. Someone says, do I see a cap on the number of beneficial owners? No. Unlike the KYC form that you fill out when you open a bank account, beneficial ownership under the Corporate Transparency Act does not have a cap. You can have an unlimited number of beneficial owners in any single reporting company. Question: would one who relies on an external CPA to handle important details from taxing to filing government forms be considered a beneficial owner? Probably not, but it would depend on the facts. You should consult an attorney. You should also look at the FAQs on FinCEN's website. That's where things get hairy. Great question here from, this is probably a lawyer, I suspect. An individual asks, what would be reported if the beneficial owner is a trust or a corporation? Great question. I'm going to put a pin in that one, and I'm going to come back to that towards the end. So as I mentioned, I'm the founder and CEO of the FinCEN Report Company. We have an online filing solution that helps you file your reports. If you want to check it out, go to fincenreport.com. Look in the upper right-hand corner of the screen for the Get Started button. Click on that. When you do, you're going to see what you see on the lower right-hand side. All we're going to do is ask for your name and email address. That will allow you to create your personal account. You can then begin to use the software to create accounts for companies, connect those companies to individuals, and then begin to compile the reports. All of that stuff is free. Creating the individual accounts, connecting with people, there's no charge for that. We don't charge anyone until you actually get around to filing the first report. This is what it looks like. If you're a law firm and work with us, we have a dashboard that helps you organize companies, but we're not going to get into that today. Let me give you a few quick examples, okay? So Larry, Bill, and Sally form a corporation. They each get 1,000 shares of common stock. Larry is the CEO, Bill is the CFO, Sally is the head of marketing, and all three of them are members of the board. Who are the beneficial owners who need to be identified in the report? This one is easy. Example number 1 always is. In this case, each of Larry, Bill, and Sally have 33% of the outstanding common stock. It's more than 25. This is a corporation, so we apply the corporate capital rule, which means that we count both voting stock and non-voting stock. And in this case, each of them is a beneficial owner. We're done. Just to make sure, though, we would also go and we would apply the substantial control test to see whether any of these individuals would also be a beneficial owner by virtue of substantial control. In this case, both Larry and Bill would be, because they are senior officers. As the head of marketing, Sally is not a senior officer, so she is not a beneficial owner by virtue of that test. But because all three of them are on our board of directors, and remember, our rule is that if you're on the board you almost certainly have substantial influence over major decisions. So I would also count all three of them as having substantial control and therefore being beneficial owners. But it only matters if you're a beneficial owner once. You don't have to, you don't get extra credit for satisfying the test in more than one way. So our final answer here is that both, rather all three of Larry, Bill, and Sally are beneficial owners. Let's change the facts just a little bit. This time, same corporation, same Larry, Bill, and Sally. This time, Larry and Bill get 1,000 shares. Sally only gets 100. Who are the beneficial owners this time? Well, the answer is that at the moment, Sally is not a beneficial owner by virtue of ownership percentage. Remember, she's also not a beneficial owner by virtue of her title. So she would only be a beneficial owner if she had substantial control for some other reason. Well, in this case, she does. She's on the board of directors, and so I would include her for that reason. So again, the answer is the same this time. It's still Larry, Bill, and Sally, but this time we had to dig a little bit deeper into the analysis with respect to Sally. We said she was a beneficial owner because she was on the board. Our last example for today before we move on. Larry, Bill, and Sally form the corporation. In this case, an investor comes along, Blackbeard. Blackbeard invests $1 million, gets 1,000 shares of preferred stock. And let's assume for the sake of argument that his preferred stock is going to convert into common at the ratio of 1:1. Let's also assume that Blackbeard has the power to appoint one member to the board of directors. Now, who are the beneficial owners? Well, remember when we first got started talking about percentages, I said that there was a rule called the present time rule that said that we had to treat all of our convertible securities as having been converted. In this case, Blackbeard has 1,000 preferred shares that convert 1:1 into common. So we're going to treat his convertible shares as if they are converted. Post-conversion, there are 4,000 shares outstanding. Each of Larry, Bill, Sally, and Blackbeard has 1,000 shares, which is 25%. So on that basis, all four of them are beneficial owners. Now, when we apply the substantial control test, things get a little bit more complicated. If Blackbeard used his power of appointment to appoint himself to the board, I would say he has substantial control by virtue of being on the board. If Blackbeard used his power of appointment to appoint someone else to be on the board, then we might actually have a fifth beneficial owner, being that individual who was appointed to the board. So we talked a little bit about the penalties for non-compliance. We don't need to obsess on that too much. Just realize that you should be getting started on this now. Figure out who are your beneficial owners, whether you're going to need legal assistance getting this done or not, and if so, where are you going to go? Depending on the situation in your company, it may be that you decide to make some changes in order to make things simpler or improve your reporting. I often suggest that companies adopt a CTA compliance policy. This will give them some power to compel their investors to give them the information that they need. If you decide to use a reporting system like FinCENreport.com, it actually makes it easier for you to get and collect that information, keeping all of the investor information confidential and secure in our encrypted online filing service. So that is the end of my prepared slides. Let me turn back to the questions and see if I've come up with any other questions here. And then Sarah may have some remarks as well. Oh, I know, I promised this question owner I would come back to them in the case of the trust. So let's go back to our example with Blackbeard. Let's imagine instead of Blackbeard being our investor, it was the Blackbeard Trust that was the investor, okay? Now, the Blackbeard Trust has 25% or more, so they would be a beneficial owner. But we don't usually identify entities. Instead, we identify individuals. So we need to figure out which individual should be identified by virtue of the Blackbeard Trust. You'll need legal help for this, but there is a rule for this in FinCEN's regulations. And the answer is that it will either be the trustee of the trust, the grantor of the trust, or the beneficiary of the trust, depending on the facts. It's the trustee if the trustee has the power to dispose of all the assets in his own discretion. It would be the grantor of the trust if the grantor has the power to revoke the trust and take it all back. And it is the beneficiary if that beneficiary is the sole beneficiary and has the power to require a distribution of substantially all the value from inside the trust. So depending on the facts, it would be one of those three things. But to expand on this question, let's imagine that instead of Blackbeard Trust, it was an exempt reporting company. Let's say it's a publicly traded company. Publicly traded companies are exempt. So Larry, Bill, and Sally form the corporation, and Microsoft, a big publicly traded company, buys those 1,000 shares of preferred stock. We do the analysis. Larry, Bill, Sally, and Microsoft are our four beneficial owners. What do we do for Microsoft? Do we have to go figure out who the owners of Microsoft are? No. If the entity that owns the interest in the reporting company is itself an exempt reporting company, you do not have to look up the chain of ownership. You just put down in the report the full legal name of the exempt reporting company. So in our BOI report for this particular example, we would give the names of Larry, Bill, and Sally. They would provide their 5 pieces of identifiable information. And then we would say Microsoft Corporation is also a beneficial owner. And that would be the end of the report in this example. So there I go. Whoops, I think I just lost my slides. Luckily, I still have the questions up in front of me here. Does this apply to gig workers and solopreneurs? Yes. It doesn't matter what you do. If your entity is an LLC, a limited partnership, corporation, or other type of reporting company, you have to go through the analysis. Doesn't matter that you don't make a lot of money. It doesn't matter what you do with your business. Someone asked, did you say the business address cannot be the same as the residential address? No, I definitely did not say that. Addresses. When you file the BOI report, you must provide the residential address for each beneficial owner, not their business address. If your company is one that must report the company applicant, a company applicant may use their business address in lieu of their residential address if they are in the business of forming reporting companies. So if it's a lawyer, accountant, paralegal, that individual can probably use their business address. Question, if a business is licensed as an LLC but has no sizable revenue and doesn't file taxes, does it have to file a report? Yes. First of all, I don't know what it means to be licensed as an LLC. So I'm going to assume that you mean it actually is an LLC. It doesn't matter that the LLC has zero money, zero customers, and has no good reason for being at all. It needs to file. If you find yourself in the situation of owning an LLC that maybe you created years ago and you've never done anything with it, dissolve it. Make sure that it is fully and finally dissolved so that it no longer exists as a matter of state law. If you do that, then the entity no longer needs to file. Just make sure you get it done before the end of the year in order to beat that deadline. Last question here. If pre-24 entities are cleaned up or closed in 24, is the end of 24 the date used for the info reported in the first report? Not quite. So let's say we had an entity we created in 23. Here we are in February 24, and we say, oh, darn, I don't need that entity anymore. So we dissolve it here in February 2024. Now be careful with dissolution. Dissolution varies from state to state. You want the entity to be fully and finally dissolved so that it no longer exists as a matter of state law. When the entity no longer exists as a matter of state law, it's no longer a reporting company, right? Because it's not an LLC, it's not a corporation, it doesn't exist. That entity does not need to file at all. So this is a good time to do some housekeeping and clean up and get rid of any defunct entities that you no longer have a need for. Question asks, I joined late. I'm sorry. You're going to want to go back and Sarah will tell you how you can access the recording. Question, if you are an insurance agent producer and have a business out of your home, do you have to file? You have many questions and they cover over several different pieces. You probably need to consult an attorney. Is there any hope that this will be repealed? No. After filing in 2024, will the company need to file on an annual basis? Go back to segment number 1. There is no annual filing, but you need to monitor your beneficial ownership and the 5 pieces of PII for every one of your beneficial owners. If any one of them changes, ever, you have 30 calendar days in which to file an amendment to your BOI report to update your file. If you don't, you have a $500 per day fine. If you willfully fail to do so, it is a felony. I hope that covers it. I'll hand it back to you, Sarah.
Yes, thank you so much. That was very thorough, and I know that people will definitely want to take a look at the recording and also have those slides as a reference point. So we will absolutely package that up and send that out to you either later today or tomorrow. So watch your email for that. And then of course, all of SBAM's webinars are on our website under the resources tab and media hub. So if there's other topics you're curious about, or if you have ideas for topics you'd like us to cover, please let me know and we'll take that into consideration. So again, Jonathan Wilson, thank you so much for your time today and your expertise. We appreciate it, and thank you all who joined us. Have a wonderful day.